Next, let's evaluate tangible asset investments. So tangible, as the name implies, is going to be an asset that is a physical asset that we can touch, not something that's going to be a little more abstract in nature, say a stock, a contract, etc. So the most common tangible assets we can think about are collectibles. So paintings, sculptures, coins, things that are going to maintain a capital appreciation over time, and we expect that the value of these assets would increase over time. They're not necessarily considered efficient in the market simply because they're based on a variety of factors. They have to have specialists determine what the value of these assets would be over time, and as such it makes them quite illiquid in terms of being able to readily convert them to cash in the form of a sale. On the other hand, items like precious metals tend to be a little bit more marketable, but these move inversely with stock prices. Therefore, it's useful to have them as some sort of hedging tool to offset, say, volatility in the stock market. So the most common precious metal that people think of for hedging is gold, but can also be other metals like silver or platinum. So we can directly own gold in the form of coins or bullion or bars if one is able to afford that, but also indirectly too. So there are gold ETFs and also mining stocks or companies that are working directly with the extraction of gold, as well as mutual funds that are also tied to the value of gold. And we can also have futures and options contracts written on these, since gold is considered a viable commodity. Additionally, other tangible assets would be things like natural resources. So oil, gas properties, as well as timber and minerals, potentially iron ore, etc. Anything that's going to be coming from the earth that can be extracted and has value for a society. So the advantage here with owning natural resources is that there are some pass-through tax benefits that the investor can achieve, but generally they're negatively correlated with other financial assets. On the other hand, this is a way to help, that negative correlation helps to diversify a portfolio further. The disadvantage here is that there's quite a high degree of risk with these natural resources because the price tends to change constantly and has a lot of risk exposure to politics, legislation, contracts regarding land usage, etc. So there is a high degree of risk associated with these. One can participate in the exposure to natural resources not just by owning the assets outright, but also participating in the market in a few other ways, such as with limited partnerships, also with the stocks of companies that develop the natural resources. So investing in a mining company of say, or an extraction company of oil, a fracking company, rather than owning the land outright where the fracking is taking place. And also with mutual funds specializing specifically in natural resources. So having some kind of exposure to tangible assets is quite significant for adding an extra layer of diversification for a portfolio, namely because they're not necessarily directly correlated with the performance of, say, the stock market. So it helps us to balance out that risk factor.